Real estate professionals must understand the variety of loan programs available so they can help buyers navigate options without giving unlicensed mortgage advice. Each loan type serves different borrower profiles and affects the structure and success of the transaction. Common loan types and key features. Conventional loans. Offered through private lenders, banks, credit unions, mortgage companies. Require stronger credit scores, typically 620 or higher. Available as fixed rate or adjustable rate mortgages, ARMs. Require private mortgage insurance, PMI, if borrower puts down less than 20%. Example: a buyer with a 700 credit score and 10% down may qualify for a conventional 30-year fixed loan, but will need to pay PMI until they reach 20% equity. FHA loans, insured by the Federal Housing Administration. Designed for first-time homebuyers or those with lower credit. Require only 3.5% down if credit score is 580 plus. Allow for higher debt-to-income, DTI ratios. A buyer earning under the county's income cap may purchase a home in a qualifying rural area like Pinal County with no down payment using a USDA loan. Portfolio loans. These are non-conforming loans held by the lender rather than sold on the secondary market. Useful for borrowers who may not meet standard guidelines, e.g., recent credit issues, self-employment, unique property types. Often have higher interest rates or stricter terms but greater flexibility. Example: a buyer with a recent short sale may still qualify for a portfolio loan if the lender is comfortable with their income and cash reserves. Benefits and risks of each loan. Type benefits. VA loans. Lower interest rates, no down payment, no PMI. FHA loans. Easier qualification with lower credit scores. USDA loans. 100% financing for eligible areas. Portfolio loans. Flexible for non-traditional borrowers. Conventional loans. Strong option for buyers with good credit and 20% down. Risks. FHA. MIP lasts the life of the loan unless refinanced. USDA. Geographic and income restrictions. VA. Strict appraisal standards may slow closing. Portfolio loans. Often carry higher interest rates. ARMs. Interest rate and payment may increase over time. Matching loan types to buyer profiles. Choosing the right loan depends on multiple borrower factors: buyer profile factor, best loan options, low credit score FHA, portfolio loans, no down payment VA, if eligible, USDA, if in qualifying area, rural property, USDA loans, veteran, service member, VA loans, stable employment and savings, conventional loan, self-employed portfolio, bank statement, or non-QM loans. Example: a self-employed buyer with strong bank statements but inconsistent taxable income might work better with a portfolio loan rather than a conventional loan that requires tax returns. How loan type impacts the real estate transaction loan programs, influence timing, documentation, and closing success. FHA and VA loans may require additional appraisal conditions or repairs. Conventional loans generally have faster underwriting and fewer property condition hurdles. USDA loans require extra time for government review, potentially delaying closing. Agent responsibilities. Ensure the buyer is pre-approved for the loan type before contract acceptance. Communicate with lender regarding contingency timelines and appraisal requirements. Track key dates such as loan status updates, LSU, and loan commitment deadlines. Statutes and compliance considerations, AAC, R4 28 1101A. Requires agents to protect and promote the client's interests. Advising clients to explore loan options within their qualifications fulfills this duty. AAC, R4 28 1101I. Requires the communication of all material facts. Loan product suitability and approval requirements directly affect the buyer's ability to perform. ARS Paragraph 6, 991.02 covers loan originator licensing and conduct. Real estate licensees must refer clients to licensed professionals for mortgage advice. Fair Housing and Equal Credit Opportunity Act, Federal, requires non-discriminatory assistance in helping clients access all financing opportunities. Agents should never steer based on race, gender, income level, or protected class. Conclusion: understanding loan programs allows real estate agents to guide buyers toward appropriate financing options while respecting licensing boundaries. Whether it's a veteran needing a no-down payment VA loan or a rural buyer seeking 100% financing through USDA, agents must know how loan selection influences both qualification and closing success. Always remember, refer clients to licensed loan professionals. Disclose any affiliated business relationships. Track loan milestones and communicate clearly with all parties. Require mortgage insurance premium, MIP, for the life of the loan unless refinanced. Example: a buyer with a 640 credit score and limited savings might qualify for a $250,000 FHA loan with $8,150 down and monthly MIP. VA loans, backed by the U.S. Department of Veterans Affairs. Available only to eligible veterans, active duty military, and qualifying spouses. No down payment and no PMI required. Requires a certificate of eligibility, COE. Example: an eligible veteran purchasing a $300,000 home may do so with $0 down and no monthly mortgage insurance, significantly lowering the cost of ownership. USDA loans, offered through the U.S. Department of Agriculture. Provide 100% financing for homes in rural and suburban areas. Borrowers must meet income limits, and property must be in a USDA-eligible zone. Require a guarantee fee, similar to mortgage insurance. Example: